Equities have seen a strong rally since their April lows. Is this sustainable, or is it time for investors to change course? With the Fed putting through a 25 basis point rate cut in September, attention is now turning to the pace of further cuts ahead as the Fed strikes a balance between protecting against further weakness in the labour market and bringing inflation down to its long-term 2% target. In our view, the Fed will likely do 2 more 25 basis point cuts in 2025 against a backdrop of relatively stable growth next year. Thus, the longer-term equity bull is likely to remain broadly intact, as such cuts in a non-recessionary environment are likely to have a positive impact on liquidity and risk asset valuations. Still, we cannot rule out the risk of a short-term consolidation following the strong performance in risk assets over the last few months. Hence, we prefer to calibrate our overall exposure by trimming some risks and downgrading our overweight position in European equities to neutral, as risk-reward in the region appears to be balanced at this juncture. Valuations are no longer cheap, consensus growth expectations for next year are lofty, while macro and tariff-related concerns still linger. On the flip side, we retain our overweight position in Asia ex-Japan equities. History shows that Fed rate cuts and a weaker US dollar tend to benefit Asia ex-Japan equities, with price-to-earnings multiples often expanding. At the same time, Asian central banks are also likely to ease policy further, while a number of key economies are set to receive a pro-growth fiscal boost. As for China and Hong Kong equities, we believe the ongoing rally still has legs given a sizable dry powder in the form of savings and deposits held by Chinese households, potential stimulus ahead, and undemanding valuations still. In fixed income, we remain neutral on duration as we expect long-end US Treasury yields to move higher towards 5%. Within developed market fixed income, we hold neutral and underweight positions in investment grade and high-yield bonds respectively. Within the emerging market fixed income space, we are neutral on corporates and underweight on sovereigns. We continue to see gold as an effective hedge against inflation, fiscal sustainability concerns, and geopolitical risks. I am Joseph, and this is Bank of Singapore CIO Investment Institute.
For more information, please refer to this month's monthly investment guide.